In this video, we're going to look at the accounting treatment for impairments when it comes to the third category, which we need to look at, which is goodwill. Impairment testing for goodwill is significantly different from the impairment test we've already discussed. As we noted in Chapter 11, goodwill is a unique asset. It's not separable from the entity as a whole. Because a firm cannot separate goodwill from a specific set of net assets, it cannot associate goodwill with a specific stream of cash flows, which is what we did for both tangible fixed assets and other intangible assets. Firms associate goodwill with the group of net assets in the reporting unit, which is an operating segment or one level below an operating segment. The codification gives us guidance on what an operating segment is. It has to have three characteristics. First, it engages in business activities that may earn revenues and incur expenses. The chief decision maker regularly reviews the performance of the segment, and the segment's discrete financial information is available. Because goodwill is not subject to amortization, and it has an uncertain value, U.S. GAAP allows companies to either make a qualitative evaluation annually to determine whether it's more likely than not that there is an impairment, or they can go ahead and just conduct a quantitative test for impairment of goodwill annually. Annual goodwill impairment testing is very complex, it's time-consuming and expensive, so it may be difficult to justify from a cost-benefit perspective. That is why U.S. GAAP permits the qualitative evaluation option. It's possible that the annual impairment assessment is performed differently than at year-end, so you don't have to do it right at year-end. You can perform the fair value measurement for each unit at any time during the fiscal year, as long as it uses that measurement date consistently from year to year. A firm can also use different measurement dates for different reporting units. After identifying the reporting unit, the firm compares the fair value of the reporting unit, which includes any goodwill, to the carrying value of the reporting unit, including goodwill. The fair value of the reporting unit is the valuation of the entity as if the company were going to be sold in a business combination. So you're going to need a lot of appraisals and valuation that goes into fair value for a reporting unit. If the fair value is less than the carrying value, then the impairment loss is equal to the difference. However, the impairment loss is limited to the carrying value of goodwill. Let's look at an example. Levi and Peter's Athletic Emporium provides us a table with a lot of information. So let's take a look. First of all, there's been a qualitative assessment of goodwill, and it is more likely than not that goodwill is impaired. So we have to go on and do a quantitative test. The quantitative test compares two things: fair value of the reporting unit, which includes goodwill, to book value of the entire unit, including goodwill. So we're looking at 1,000, the top number, and 1,100, the bottom number of this particular table. So if book value is 1,100, fair value of the entire unit is only 1,000, well, we have an impairment. So all we do is subtract one from the other, and the difference is a $100 impairment loss. And so we go ahead and make the journal entry, and we show the impairment loss on goodwill, and goodwill is credited for 100. So goodwill originally had a $300 balance, and with this adjustment, it's going to go to a $200 balance. Well, let's look at case 2. We do the qualitative test. We have to go on and do the quantitative test, and in this case we compare 500, the top number, to the bottom number, 900. Okay, so we can see that book value is at 900. That's for everything in the reporting unit. Fair value is only 500, so clearly we have an impairment. But there's something different about this case. Look at the book value of goodwill. It is 300. If we're going to do an impairment of goodwill, we can't write goodwill down lower than that 300. So 900, 500, we take the difference, it's 400. We can't write down goodwill to a negative 100. So what we do is we take the impairment on the amount limited to the carrying value. So we take the impairment loss of 300 and we wipe out goodwill.